Hi, I'm Richard Jones, Chartered Financial Advisor and previous winner of the Personal Finance Society's Investment Specialist of the Year. And what I'm going to talk to you about here is investments. Now, investments can seem like a really complex area, but like anything else, if it's broken into enough component parts, it's fairly simple. What I tend to tell people when looking at investments is that we're going to divide it into three bits. The first one being who or what we're investing for. The second, what we actually need out of an investment. And thirdly, the level of risk. So the first thing to think about is who or what you're investing for. Now, typically, this is people investing for themselves in the future, but there might be a really specific purpose for that. It might be saving for the deposit for a first house, or it might be saving for your retirement. Either way, being really clear about what you're trying to achieve is a good starting point. Secondly, we look at what you actually need from an investment. Now, this can involve things like how much access you need to an investment, what the taxation of it will look like. Ultimately, this is the most complex area and an area where most people will find a benefit taking advice. Things to consider are the term of an investment, as in, is this going to be something where you want the money in 2 or 3 years, or is that actually 20 or 30 years in the future? Also, what you would like in terms of involvement from your investment. Do you want to be involved directly and make day-to-day decisions, or do you want to pass all responsibility of that over to somebody else? And the third thing to look at is the level of risk. Risk is best viewed as a spectrum, from low risk at one end to high risk at the other. And what that will look like is at this end, cash, savings accounts, not particularly volatile, moving through things like fixed interest investments, alternatives, and stocks and shares. Now, as you go along that spectrum, the level of volatility you see increases, but all types of investment have risk. So for example, if you're investing in really low risk asset, like savings accounts, what you have is inflation risk, the risk that inflation will go faster than your investments grow, and interest rate risks, the idea that interest rates may change in a way that doesn't favour you. In other areas, such as investing in alternatives, there are other risks like liquidity. For example, if you own something that's not easy to sell, how suitable will that be when you want to use your investment? When we're looking at the level of risk that is appropriate for an investment, it's really important to consider those things. What we're investing for, what the end purpose is, what we need out of that investment, and how much risk we're taking. And how much risk we're taking isn't as simple as it may first appear. So you will have your own view on how much risk you are comfortable taking. But actually, other factors play into that. For example, your time horizon. Even if you're really cautious, if you've got a 30 or 40-year time horizon, it may be appropriate to take more risk than you normally would. Likewise, if you're really tolerant towards the idea of risk, but you've got a really short time horizon, you may not wish to take as much risk as you normally would. Other considerations are, how significant is this amount of money to you and your life? If it's your life savings, you may want to be a bit more cautious than if it's £100 that you're saving every month. One final consideration is there anything from an ethical perspective which should focus your investment choices? For example, is there anything that you simply do not want to invest in?